Welcome to today's video on the 60-day 529 rollover trap. We'll walk through how to move college savings between 529 plans without triggering taxes or penalties. We will focus on the critical 60-day deadline, proper documentation, and the exact coding you must instruct the new provider to use. By the end, you'll know how to execute a tax-free rollover with confidence. First, we'll set the stage with what a 529 plan is. Next, we will compare direct transfers and indirect rollovers. Then we will dive into the 60-day deadline, show you exactly how to code your deposit, and explain the documentation and forms you need. After that, we will discuss penalties for missing the deadline and how beneficiary changes work. Finally, we will test your understanding with a short quiz. Before we proceed, a quick but important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or investment advice. 529 plan rules can vary by state and may change. Always consult a qualified tax professional or financial advisor about your specific situation. Additionally, be aware of the one rollover per 12 months rule per beneficiary, and verify current IRS and plan guidelines before executing any transaction. Now that we have our disclaimer out of the way, let's define what a 529 plan is. It's a tax-advantaged savings account intended to pay for qualified education expenses. Earnings grow tax-deferred and can be distributed tax-free if used for qualified education costs. Plans are sponsored by states, and you can generally use the funds nationwide. Some states offer tax deductions or credits for contributions. Be sure to check your state's rules. Moving forward, let's compare the two ways to move 529 money. A direct transfer is executed provider to provider, meaning the funds move behind the scenes. You never receive the check, there is no 60-day clock, and the risk of misclassifying the transaction is lower. In contrast, an indirect rollover means you receive the distribution and must deposit it into another qualified plan within 60 days. Because you touch the funds, you must be precise. The 60-day deadline is absolute, and correct deposit coding is essential to avoid taxes and penalties. Next, let's focus on the 60-day rule. When you receive a distribution check via an indirect rollover, you must deposit the entire amount into a new qualified 529 within exactly 60 days of receipt. This deadline is strict. If you miss it, the earnings portion becomes taxable at ordinary income rates and is generally subject to a 10% penalty. Even if the account had minimal earnings, you must still adhere to the timeline. Keep precise records of the check date, receipt, and the deposit date. Now, here are the practical steps. First, ensure the destination 529 account is open and ready. Second, receive the distribution check from your old provider. Third, deposit the full amount into the new plan within 60 days. Fourth, and most critically, instruct the new provider that this deposit must be coded as a 60-day indirect rollover. Do not allow it to be treated as a standard contribution. Finally, save all documents, including confirmations, statements, and any correspondence. Let's make the coding point unmistakably clear. Tell the receiving provider, in writing if possible, that the deposit is a 60-day indirect rollover. If they process it as a standard contribution, it will not match the 1099-Q the former provider issues, which reports the distribution. That mismatch can lead to IRS scrutiny and potential taxes and penalties. Proper coding ties the distribution to the rollover and documents that the movement was tax-free. As we continue, let's talk documentation. The old provider will issue Form 1099-Q showing the gross distribution. You need the receiving provider's records to reflect that your deposit was a 60-day indirect rollover. Retain copies of the check, deposit receipts, and any dated statements that confirm the deposit date. Include notes about the beneficiary relationship and the reason for the transfer, especially if you change the beneficiary, to strengthen your paper trail. Here is a quick table of the paperwork that matters. Form 1099-Q reports the gross distribution from the old plan. The receiving plan's confirmation must show the deposit coded as a 60-day indirect rollover. Account statements prove dates and amounts, especially around the 60-day window. Internal provider forms help standardize the correct language. Finally, your personal notes can document beneficiary relationships and timing if the IRS ever asks for clarification. If you miss day 60, the earnings portion of the distribution becomes taxable at ordinary income tax rates and is generally subject to a 10% penalty. Principal amounts are typically not taxed, but you lose the tax advantage status on the earnings. If this happens, consult a qualified tax professional immediately to understand your options. Now let's address beneficiary changes. Moving funds between qualifying family members, such as from a parent to a child, is generally permitted and tax-free if you follow the rollover rules. When changing beneficiaries, document the family relationship and the purpose for the transfer. Also remember the one rollover per 12 months limitation that applies to the same beneficiary. Always verify current rules with your plan and a tax professional. Quiz time. Question: if you receive a 529 distribution check and plan to roll it over, by when must you deposit the funds into the new qualified plan to keep it tax-free? The options are 30 days, 45 days, 60 days, or 90 days. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 60 days. The window is strict, so make sure to complete the deposit before the 60th day. Second question: how should you instruct the receiving 529 provider to process the deposit if you received a distribution check? The options are as a standard contribution, as a 60-day indirect rollover, as a beneficiary change only, or as a return of excess contribution. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to instruct the provider to process the deposit as a 60-day indirect rollover. Using clear language helps the provider code it correctly so the transaction aligns with the 1099-Q. This flowchart shows the entire indirect rollover path. It starts with the old provider issuing a distribution check to the account owner. A 60-day countdown begins immediately. The owner must deposit the funds into the new 529 provider before day 60. A decision point captures whether the receiving provider codes the deposit as a 60-day indirect rollover. If coded correctly, the flow leads to a tax-free rollover outcome. If miscoded as a standard contribution or deposited after day 60, the flow leads to a taxable distribution and a potential 10% penalty on earnings. To recap the essentials, clearly state the deposit is a 60-day indirect rollover. Ensure the 1099-Q matches the receiving plan's rollover coding. Deposit before day 60 without exception. Maintain thorough documentation. Confirm the one rollover per 12 months limitation for the same beneficiary. And, if you want to minimize risk, consider using a direct transfer instead. In summary, 529 funds can be moved tax-free if you follow the rules. The 60-day window is strict for indirect rollovers, so deposit on time. Use explicit rollover coding that aligns with the 1099-Q. Keep thorough documentation to defend the tax-free treatment. Transfers among family beneficiaries are generally allowed when the rules are followed. If needed, consult a professional. Thanks for watching. If this content helped you avoid a tax trap, please like the video, share it with someone planning a rollover, and subscribe for more practical guides. Share your questions and experiences in the comments so others can learn from them as well.